Hi, beautiful people. It's Jerry again, and I've heard your cries. Yes, some of you were coming to my inbox and say, please do another question so that we become ready for current risk questions. So there is this question that is a RADIAN call. All right, I found it very, very useful for revision, especially for you guys who are having an exam next week. So I want you guys to pay very careful attention as I present. So our question reads as follows. Okay, I'm sure you are seeing the screen clearly. This is the scenario. It's a section B type question. Expect to meet a question of the similar structure in your upcoming examination. RADIAN company, whose home currency is the dollar, expects to receive 750,000 euro from a credit customer in the European Union in 6 months' time, and to pay 500,000 euro to a supplier in 12 months' time. So we are given two things here. There is a receipt in 6 months, all right, and a payment in 12 months. The spot exchange rate is euro 2.349 per dollar, and the following interest rates are available to RADIAN company. So we are having the rates as usual, right? And when you see this particular arrangement or this tabular format, you just have to think of the money market hedge. It should come to you as obvious by now when you are ready. If you are ready to sit for this examination, you should know that when you see, this type of arrangement, the money market hedge should be suspected. The inflation rate in RADIAN course home country is 1.5% per year, and in the European Union is 3.0% per year. Right? I've given you guys an extract of the formula sheet. All right, the extract, it might, it is actually going to be useful in the computation of some of the requirements to this question. So let us attack requirement number 1. What should RADIAN Core do? What should RADIAN Core do now to correctly set up a money market hedge on the 750,000 euro receipt expected in 6 months' time? You now know these things. If you are talking of a receipt, as we have learned from question Nedwen, if it is a receipt, we are going to start by borrowing. We borrow, then we converted spot, and then we deposit or we invest. So we are going to borrow the currency, okay, the currency to which the receipt belongs. If it is a euro, we are going to borrow euros. If they are dollars, we are going to borrow dollars, something like that. So in this case, we need to receive 750,000 euro in 6 months' time. So we are going to borrow euros. All right. So obviously, by elimination, given these choices, anything that doesn't have a euro and that doesn't have a a borrow, then it's wrong. So obviously, D is wrong. Okay, D is cancelled out. Now, remember, we are going to borrow the present value of the amount, not the actual quantity, but the present value, which is a discounted amount. So we know from the question, the amount to be received is 750,000 euros. So the borrowing rates are here, right? And we are going to borrow euros. So obviously we come to the euro line, okay? And this is the percentage we are going to use. However, this is an annual percentage, all right? We are going to receive the amount in 6 months time. So we need to reduce this amount, that rate to 6 month rate. So obviously 6 months is half a year, all right? So we multiply the percentage by half. This means that we are going to use 4%. Okay, so to discount the amount, that's 1 plus R, isn't it? 1 over 1 plus R. So the amount was 750 euro, 750,000 euro over 1 plus R. Our R is 4%, so that's over 1.04. And this should come to, if we use our Excel, this should be equal sign 750,000 divided by 1.04. So this means that we only have to borrow okay, let's round up. So we need to borrow 721,154 euros. So our answer is A. It's very simple, isn't it? Good. Remember, I want you to take note that the question only wants us to do the first step, right? That's how you set up your hedge. The second question, which of the following would correctly hedge on the 500,000 euro payment expected in 12 months time? All right. I loved this question for the fact that it gives us all the perspectives required for the receipt arrangement and for the payment one. So this was the chronology for a receipt. Now, when it comes to the payment, we just do the opposite. We start from bottom up. So we deposit. We start by deposit, then convert at spot, and then borrow. So which of the following correctly hedge on the 500,000 payment expected in 12 months time? Take also note that the question is not simply saying that you need to think of the money market hedge alone, but if you know the sequence in all the applicable formulae or applicable techniques, you will be home and dry. So let's look at the first option. To borrow euros. This is a payment. So this type of wording relates to a money market hedge. So, but if it is a payment in a money market hedge, do we start by borrowing? No, we start by depositing. We need to deposit 500 euros today. So obviously this one becomes wrong. We don't borrow today because this is a payment. Are we together, ladies and gentlemen? But if it was a receipt, then we start by borrowing today. But now this one is a payment. So therefore, we started by depositing. Am I talking to somebody? Can somebody say amen? Good. Now, The second option, forward rate agreement. Can we use a forward rate agreement in this situation? No, we don't use a forward rate agreement. We use we use a forward contract. A forward contract. Forward rate agreements are for interest rates. Remember this one, we want to hedge a current or a foreign exchange rate adverse movement. So we use a forward contract, not a forward rate agreement. They are very different. Forward rate agreements are for hedging interest rates movements. Now we want to hedge currents, adverse current rate, exchange rate movements. So please take note of that. So the examiners put that one as a distractor, and a lot of candidates obviously failed that one. Now, buy euro futures contracts. This one is actually the correct answer. But what does that mean? Remember, the fear for this company, their fear is that this euro payment might become expensive in 12 months to come. Right? Maybe the euro might appreciate in value, which makes it very, very expensive to get the euros and settle the liability. So to prevent such movement, such adverse impacts, they need to buy euro futures contracts. Euro futures, and then close by selling them. Is that clear, ladies and gentlemen? Good. You need to buy now, so you sell later, and in so doing, you will be hedging yourself against any adverse movement in the foreign exchange rates. Now, the last option, put options on the euro. Do we need put options? Put options, these are options to sell. All right, options to sell a currency. Now, do we need to sell euros to settle a liability in euros? No, we need to buy the euros so that we settle this liability in euros. We don't have the euro. That's the problem. We don't have the euros. So we need to buy. So the option we need is the option to buy, not option to sell. All right. So we need a call option, not a put option. So by that fact, this option becomes null and void. So the correct answer is C. You need to buy euro futures contracts for now. The third question requirement. I think we need to hurry because it's now almost about lunch hour. Lunch hour, guys. If RADIAN company continues to trade with the European Union for many years, to which of the following currency risks will it potentially be exposed? We talked about these risks yesterday in a question Nedwen. Okay, please, if you haven't watched question Nedwen, please visit that video on this channel. Yes, question, let me write it down. That's question Nedwen. Okay, question Nedwen. It explained these three risks. All right, when we talk of transaction risk, this is a short-term risk or exposure a company faces when it deals in a transaction in foreign currency or involving foreign currency. This risk impacts its cash flows if there are adverse movements in exchange rates. All right. So that's the explanation for this one. Okay, it impacts cash flows. Now, translation risk, this one is an accounting risk. Accounting, which means it's a paper risk. Cash flows are not going to be affected. Okay. To some extent, if there are liabilities and assets involved in the trading relationships of the company, which are international in nature, okay, or which involve trade between countries, then in the end there could be some impact in terms of translation, because investors will be worried if balance sheets tend to present significantly different figures. All right, so in that case, yeah, investors would be worried. This year, maybe the assets and liabilities were around 5 million. Then because of exchange rate movements, they're now 2 million and so forth. Even if the cash flows were not impacted, but that type of movement worries much investors. All right. So you need to take care of that. Sometimes the question is explicit to tell you about such impacts on the statements or financial positions of companies concerned. All right. However, the bottom line is that cash flows are not directly impacted. Economic risk. This one is a long-term form of transaction risk, and it has got a bearing in terms of the competitiveness of an entity in the longer term. Right. So exchange rate movements over a long period of time tend to affect a company's performance. All right. Let's say, for example, over 3 years, maybe the dollar or the euro or the pound starts to appreciate or to depreciate. It becomes a worry in terms of the performance of the company. So that one is much of a longer term risk. Now, coming back to RADIAN call, the question is saying, which of these risks is going to affect this company if it continues to trade with the European Union for many years? Obviously, economic risk cannot be ignored in this case. So economic risk should be a choice, the first choice. Also, because we will be trading, cash flows are going to be impacted. Therefore, transaction risk can also not be ignored. What about translation risk? Like I said, translation risk can only be considered if we have been told in the scenario about assets and liabilities. Unfortunately, in this case, the examiner did not give us much information on whether assets and liabilities were resulted or were being at play in this situation. So you cannot say translation risk is going to be impacted. It's going to be there. So it's not safe. So the correct answer is 1 and 3 only. Fourth requirement. RADIAN company is planning to issue debt and is considering the use of interest rate derivatives to protect against a rise in interest rates. So, to issue debt simply means they want to borrow. Okay? So they are worried that interest rates might increase, making the loan very, very expensive. Okay? That will make the loan very, very expensive. So the examiner wants you to tell him or her what you understand by the debt issuance theory. What do you understand about that? What should be the implications of taking debt? All right. So which interest rate derivatives, bear that in mind, ladies and gentlemen. Okay. Interest rate derivatives. Forget about the foreign exchange derivatives, Forex derivatives. We are at interest rate derivatives or hedging instruments. Okay, which of the following statements are true? Interest rate options allow the buyer to take advantage of favorable interest rate movements. Yes, an option gives you the right but not obligation to do something. So if the interest rates are no longer favorable, you can just opt out. You're not forced to participate in the transaction, unlike in those forward arrangements and so forth, where they become reached, okay, or in the currency and so forth. In futures contracts, right? Here, being an option is just, it gives you the right to exercise it if you are happy. If you are not, you just simply ignore or opt out. So the first statement there is true, is correct. A forward rate agreement does not allow a borrower to benefit from a decrease in interest rates. Yes. Why? Because this is a rigid agreement. It's different from an option. So if there is interest rate decrease, once you've entered into a forward rate agreement, you cannot go back and say, please allow me to benefit. All right, it's very, very rigid. So you are not going to benefit from the decrease in interest rates. Like I said, here, this is a loan situation. Okay, they are worried that if they enter into the loan agreement, the interest rates might rise and rise, and this becomes cheaper in terms of interest rate payments. So they've got an option of entering into interest rate options or into forward rate agreements. So you need to tell the examiner the implications when it comes to entering into a forward rate agreement. It is very, very expensive. All right, in the sense that once you have entered it, if the interest rates become favorable, you can just watch them, but you cannot come out of the arrangement, and you cannot benefit from them. Why? Because they set a fixed rate. They set a fixed rate, not a variable, but a fixed rate. Is that clear, ladies and gentlemen? So this is correct. Okay, it's correct in that disadvantage. Setup is very correct. The statement is true. Now, statement 3: borrowers hedging against an interest rate increase will buy interest rate futures now and sell them at a later date. This one is a little bit tricky, but very, very wrong. Okay. Now, I want you to memorize this acronym, all right? Borrowers, okay? Borrowers sell, okay? They sell futures and buy them later. They sell and buy them later. So, for borrowers, we have got BSB. Borrowers sell futures and buy them later. What about depositors? Depositors, these ones, they buy and sell later. So we use DBS. So in this case, the borrowers are hedging interest rates increase by buying. This is wrong. If we are hedging against an increase in interest rates as a borrower, you need to sell the futures. All right? You sell the futures now and then buy them later. This is the assumption that maybe the increase is not going to be permanent, but for a shorter period of time. Is that clear? So for now, for the purpose of you entering into the examination, you then have to tell yourself that the borrowers sell. Okay, they sell futures and buy them later. All right? But if you're a depositor, you need to buy and sell later. So this is why it becomes wrong there. All right, option C is wrong because it says that they will buy interest rate futures now and sell them later. No, the arrangement should be they sell interest rate futures now and then buy them later. All right. So the correct answer should be 1 and 2. All right. 1 and 2 only. Please replay this part of the video because if you miss it, it's gonna be trouble on exam day. Right, last question. The last requirement. I think I skipped something here. Very interesting. Which of the following would be the 12-month forward exchange rate? Yeah, we are still on this particular question. Okay, now this is where the formulas come into play. In this particular exam, the examiner has been very generous. You are going to be given a formula sheet with a lot of formulas. Your job is to pick the correct formula and utilize it correctly. So the applicable formula for you to predict future, forward rate is the interest rate parity formula. The interest rate parity. And which one of these? This is the interest rate parity. Sometimes the examiner would want you to explain the theory or the theorem. All right. So, and this one is the purchasing power parity. If you are to predict the future spot rate, we need to say current spot rate multiplied by 1 plus inflation rate of the counter currency, right? Or the counter country, something like that. In a counter country, divided by the 1 plus inflation rate of the base country, right? But we are not using this one because we are not required to predict a future spot rate. We are required to predict future forward exchange rate. So if we are not going to use this one, it means that this information in the question was just a distractor, this aspect. We're not going to use any inflation rate. Is that clear, ladies and gentlemen? Am I talking to somebody? Somebody might worry and say, the examiner can just put figures for nothing. No, this is a professional examination. Distractors are going to come, ladies and gentlemen. Distractors are going to come. All right? Remember, this is a professional examination and they just want a few people to pass, not everybody. It's not a university degree, by the way. Okay, good. So let us now come back. So the interest rate parity is saying that the future forward is equal to the current spot multiplied by the 1 plus the interest rate in the counter currency or counter country over 1 plus interest rate in base currency. So the base currency is the dollar, all right? So the interest rates are also given as follows. Of course, all these are the interest rates we are going to use. So which one? Are we going to pick the deposit rates or the borrowing rates? That's the question we always encounter during examinations. So the examiner has made it very, very easier for you, all right? So remember, like I said, this is our B and this is our C, which is the counter currency, all right? And the B aspects are those ones. So we need to pick what are called mid rates. We use mid rates. So for the counter currency, we use 4% and 8%. So we need to add them and get the middle figure, right? So like here, that's 4% plus 8%. Let me tidy up the place. Okay. So 4% plus 8%, this comes to 12% divided by 2. So that we get the mid figure. The mid figure becomes 6%. And then for the dollars, that's 2% plus 3.5%. This comes to 5.5%. Divided by 2, it comes to 2.75%. Good. So we then slot these figures. That's our C and our B. So we come here. We now know the formula. So the spot rate, how much was the spot rate? The spot rate, according to the question, the spot exchange rate was 2.349 euros per dollar. 2.349. Okay. 2.349 multiplied by 1 plus the interest rate for the counter currency. That's the mid rate. We found it to be 6, so that's 1.06%, 1.06 rather, over the base currency 1.0275. These are the figures we found, ladies and gentlemen. Don't be shocked. Yes, those are the figures, 6% and 2.75%. Don't be shocked, don't be shocked. Okay, and let us use equal sign 2.349. 2.349 multiplied by the bracket 1.06 over 1.0275 close bracket, press enter. So we have sorry, the writing might be very, very small for your eyes, guys. Okay, yes, I'm sure it's now clear. Good. So it means that our answer there, the predicted forward exchange rate is B. Okay, so this is our answer. Good. Coming. So guys, Here we are. We've solved this particular question in 35 minutes. In a real examination, we expect you to finish this question in as much earliest time as possible. All right, so see you guys in the next video. Thank you so much. If you are new to this channel, please subscribe. If you feel like you need a tutor, please just give me a shout. My numbers are on the screen there. All right, see you guys. Bye.